Yes, my greetings to everyone. In the ongoing series of Finance for Everyone, today we will be talking on long-term capital gains. We will be talking on the definitional aspect, the characteristics, application, calculations, implications, holding periods, tax benefits, real-world examples, exemptions, investment strategies, and the estate planning. Now, what is the meaning of a long-term capital gain? The long-term capital gain is a term used to describe the profit that an investor realizes when they sell a capital asset when they have held more than 1 year. The capital asset can be any property, any stock, any bond, real estate, and even a business. So when you sell a capital asset for more than you paid for it, the difference between the purchase price and the sale price is called as a capital gain. And if you have held the asset for more than a year, the gain is classified as a long-term capital gain. The tax treatment of long-term capital gain is different from that of the short-term capital gains. The long-term capital gains are subject to lower tax rates than the short-term capital gains, which are taxed as ordinary income. The specific tax rate that applies to a long-term capital gains depends on your income level and the type of the asset you sold. For most taxpayers, the long-term capital gains rate is either 0%, 15% or 20%. It's important to note that the tax rate on the long-term capital gains is not determined by the total amount of the gain, but by the taxpayer's income levels. For example, if you are in a 10% or a 12% tax bracket, your long-term capital gains rate will be 0%. In summary, we can say the long-term capital gains are the profits earned for the sale of a capital asset held for more than 1 year. These gains are taxed at a lower rate than the short-term gains, and our specific rate depends on the taxpayer's income level and the type of the asset sold. So we have a difference between a short-term as well as the long-term capital gains. So how it is different from the short-term capital gains? The profits gained from the sale of the short-term capital asset is a short-term capital gain, whereas the long-term capital gain arises from the sale of the long-term capital assets. Now the status of the capital asset. The short-term assets are immovable items held for less than 2 years and movable ones below 3 years, whereas long-term capital assets are immovable items that investors hold for more than 2 years and the movable items over 3 years. There's a market aspect also. The traders have a short-term market perspective and can sell over shorter periods, attaining the quicker profits, whereas the investors maintain a longer market perspective, which brings them higher profits on selling their assets. Next we have is a profit attained. The sellers may obtain a lower profits because the short holding period and the assets are not well established in the market, whereas the sellers anticipate higher profits since the asset holding period is over a year and are well established in the market. Next is on the basis of the risk involvement. It involves lower risk as the holding period is relatively shorter, whereas investing in the long-term asset involves higher risk because of the lengthy waiting period. The assets may become non-liquid later, and the taxability. 15% tax is applicable on the short-term capital gains that fall under Section 111, excluding surcharge and the cess. The STCGs that do not fall under the Section 3A are taxable at a regular income tax rate, whereas 20% tax is applicable on the long-term capital gains, excluding a cess and a surcharge. Now, there are some characteristics of a long-term capital gain. Let us discuss that. The first is a lower tax rate. the long-term capital gains are subject to a lower tax rate than the short-term capital gains and a regular income. The tax rate and the long-term capital gains varies based on your income levels, but it is generally lower than the tax rate for a shorter capital gains. Next we have is a holding period. To qualify as a long-term capital gain, you must hold the asset for more than 1 year, and this holding period is calculated from the date of the acquisition to the date of the sale. Next is we have a type of assets. Long-term capital gains can be realized from the sale of a variety of assets, including stocks, bonds, real assets, and the collectibles. Then we have is the adjusted basis. The basis of the asset is adjusted for any improvements, depreciation, or other factors that affect the value of the asset. This adjusted basis is used to calculate the gain or a loss on the sale of the asset. Now is the capital loss carryover. If you have a capital loss for a priori period, you may carry it forward or offset any capital gain in the current year. Next is your net investment income tax. High income earners may be subject to an additional 3.8% tax on net investment income, including the long-term capital gains. So this tax applies to the individual with income tax of rupees 16 crores, 12 crores for married couples filing jointly. Next is the application part of the long-term capital gain. The first is your investment. The long-term capital gains provides an incentive for the investors to hold on to the assets for an extended period rather than engaging in a frequent buying and selling. So this can lead to more stable and predictable investment returns over time. Next is we have the estate planning. Long-term capital gains can also be a consideration in estate planning, as they can have implications for inheritance and the gift tax. Next is we have a retirement planning. Long-term capital gains can be an important part of the retirement planning, as they can provide a source of income in the retirement. Many retirement accounts such as 401ks, IRAs are designed to encourage the long-term investing and offer the tax advantage for the long-term capital gains. Next is your corporate finance. The long-term capital gains can play a very important role in the corporate finance, as the companies may choose to hold on to assets for a longer period to take advantage of the lower tax rate on the long-term capital gains. Next is we now know about the calculation part of the long-term capital gains. The calculations of the long-term capital gain is based on the particular formula. The long-term capital gain is equal to sale price minus the cost basis and minus the adjustments. So in this particular formula, the sale price is the amount for which the asset was sold. The cost basis is the original purchase price of the asset plus any adjustments, and adjustments include any expense related to the purchase or the sale of the asset, such as the commission or the fees. So let's now think of a computation to demonstrate this, and assume you paid rupees 10 per share for 100 shares of XYZ stock for the total cost basis of 1000. You may sell the shares for rupees 15 for a total price of rupees 1500 after owning them for more than a year. So let us also assume that you paid your broker a commission of rupees 50 for the deal. Now the particular formula can be used to determine your long-term capital gain. The sale price into the long-term capital gain is equal to rupees 1000, cost base plus 50 rupees, that is the adjustments. The long-term capital gain equals 450 rupees. So your long-term capital gain would therefore be rupees 450 in this example. It's very important to note that the long-term capital gains are typically taxed at a lower rate than the short-term capital gains, which are gains on the assets held for 1 year or less. The specific rates at which the long-term capital gains are taxed depends on your income levels and other factors. So it's very important to consult with a tax professional for the guidance on your specific situations. Now let us talk about the capital gains taxes. The tax rates on the long-term capital gain. The long-term capital gains are often taxed at a lower rate than the short-term capital gains in general. This is so because the long-term capital gains or the gains on the assets held for more than a year are given a favorable tax treatment under this, and following are the long-term capital gains for the tax year 2021. The tax is 10%, 12%, rates are 0%. The taxpayers in the 22%, 24% and 32% and 35% income tax categories pay 15% of their income in the taxes. For the people in 37% tax income bracket, the tax rate is 20%. And in addition, there is a 3.8 net investment income tax for the taxpayers with modified adjustment gross income about specific limits that is being levied on the long-term capital gains. The barriers is 15 lakh 20,000 for individuals and 19 lakh for the married couples if they are filing jointly. The short-term capital gains, on the other hand, are subjected to taxation at the taxpayer regular income tax, which can range from 10 to 37 depending on the taxpayer's income level. These tax rates are modified time and again, and accordingly the tax rates and the percentage will be applied in the Indian context. And because these tax rates are the thresholds are subject to change, so it's wise to seek the advice of a tax expert or the consultant to the most recent tax code, which is available and updated from time to time. Now there are some important tax implications of the long-term capital gain. The long-term capital gain can have a significant impact on your overall tax liability, as they are generally taxed at the lower rates than the short-term capital gains and are also affected by your tax bracket and other tax deductions. So first, the long-term capital gains can push you into a higher tax bracket, and if the gain is large enough, for example, if you are into a 22% tax bracket and you have 50,000 rupees in long-term capital gains, your taxable income would increase by that amount and could push you into a bracket of 24% tax bracket. So this means what? This means that some portion of your capital gains would be taxed at a higher rate, which would increase your overall tax liability. Secondly, the long-term capital gains can impact your ability to claim certain tax deductions or some credits, as they have a considered part of your taxable income. Now, for example, if you have a high amount of long-term capital gains, it would reduce your eligibility for certain deductions or the credits that are phased out at a higher income levels, such as the deduction for the student loan, interest or a child tax credits. However, it's important to note that the long-term capital gains can also provide some tax benefits. For example, if you have a capital losses, from the other investments, you can use the long-term capital gains to offset such losses, reducing your overall tax liability. Additionally, if you donate appreciated assets that you have held for more than 1 year to a qualified charity, you can generally deduct the fair market value of the asset as a charitable contribution. So overall, the tax implications of the long-term capital gains depend on a variety of factors, including the size of the gain, your tax brackets, and your other income and deductions. Now let us do a concept of a corporate finance. The long-term capital gains can play a very significant role in the corporate finance by affecting the investment decisions of investors and the financial performance of the corporations. The long-term capital gains taxes can influence the investor behavior and the demand for a company's stock. If any investor expects to pay a lower tax rate on the long-term capital gains, they may be more likely to hold on to their shares for an extended period. increasing their shares for an extended period, increasing stability and reducing the volatility of the stock prices. Conversely, higher income tax and the long-term capital gains taxes may encourage the investors to sell their shares quickly, potentially leading to more significant price swings. Secondly, the corporations themselves may be impacted by long-term capital gains taxes. And if the corporation stock prices is heavily influenced by the long-term capital gain taxes, it may need to adjust its financial strategy accordingly. For example, a company may choose to issue more debt rather than equity to avoid diluting its stock and risking a decrease in the stock prices due to increased selling pressure. So, overall, long-term capital gain taxes can have a significant impact on the corporate finance, affecting both investor behavior and the financial decisions made by the corporations. So, let us see about 2010, 2015, 2020 and 2025. The holding period requirements. Assets need to be held for a longer period of time in order to be considered a long-term capital gain. This means what? This means that an asset, to qualify as a long-term capital gain, it must have been held for at least 366 days, including the date of the acquisition and the date of dispose. Any profit from the asset sale is kept for a year or less is regarded as a short-term capital gain. And it's very crucial to remember that all the assets subject to capital gain taxes, including the stocks, bonds, real estate and other investments, must meet the holding period requirements for a long-term capital gains. For some assets, it's collectibles and the section 1256 contracts, a different holding term is required. The artwork, the antiques and the precious metals are examples of collectibles held that to a subject to a higher long-term capital gain tax of 28% and require a longer holding period in order to qualify as a long-term capital gains. Regardless of the holding time, contracts covered by section 1256 such as the regulated future contracts and the options are subject to a unique tax treatment and the entities 60% of the gain to the lower long-term capital gains tax-free. The holding duration of your asset is something you should keep in mind and eye on because it can significantly affect your tax liability and your investment plans. The long-term capital gains are typically taxed at a lower rate than the short-term capital gains because holding on to assets for a longer period of time can result in tax advantage. So, what are the tax benefits of the long-term investments? The use of the long-term investing can really help you build your wealth over time and has a number of tax advantages. The favorable tax treatment for a longer capital gains is one of the main benefits of the long-term investing. The long-term capital gain taxes are typically less expensive than the short-term capital gains taxes, and this is so that the assets held for longer than a year can benefit from the tax code preferential treatment provisions. So, this is the profile of the long-term gain taxes for 2021 taxpayers. The taxes in 10% and 12% income tax rates are 0. The tax percent is 22%, 24, 32, 35. Income categories by paying 15% of their income tax. For people in 37 tax income bracket, the tax rate is 20. This means that you must have been able to pay a lower tax rate on any gains you realize and if you hang on to any investments for longer than a year before selling it. So, the long-term capital gains are given a preferred tax treatment but maintaining the investments for extended period of time and can also lower the overall taxes. So, this is due to the fact that you usually have to pay the capital gain taxes on any income when you sell an investments. However, You might be able to postpone paying taxes on those gains if you hold on to any investment for a longer period of time. Your tax liability could be decreased as a result, increasing your overall after-tax returns. Additionally, investing over long term can help you avoid paying the short-term capital gain, which are assessed at a taxpayer's ordinary income tax rates. You can avoid the tax rates on short-term capital gains and possibly pay the reduced taxes on your gains by holding the investments for a longer period of time. So, in general, long-term investments can be a successful approach to increase the wealth while simultaneously enjoying a number of tax benefits. You can lower your tax obligations and boost your overall after-tax returns by taking advantage of the long-term capital gains, favoring the tax treatment and holding the investments for the extended period of time. Now, we'll give some real-time example. You assume Mr. Ravi spent rupees 500 each share of rupees 50,000 to purchase the 100 shares of the Reliance India in January 2010. He held the shares for more than 10 years because selling them in March 2021 for rupees 2,000 per share for a total transaction price of rupees 2,000. Let's say that he forked over 500 in the brokerage fees for the deal. So, following formula we can use to determine his long-term capital gains. The long-term capital gain is calculated as follows. The sale price is rupees 2 lakhs minus the cost base is equal to 50,000 minus the adjustments, that is equal to 500. So, the long-term capital gain equals 1,49,500 rupees. So, Ravi will have a long-term capital gain of rupees 1,49,500 in this case. He is eligible for a favored tax treatment for the long-term capital gains because he owned the shares for longer than 1 year. Long-term capital gains on the equity shares are currently subjected to a 10% tax in India and on the gains over rupees 1 lakh. So, Ravi's tax obligation on the gain would therefore be equal to 10% of rupees 49,500 or rupees 4,950. Now, consider still another instance. In 2005, Sunita paid rupees 50 lakhs for a residential home. She owned the home for rupees 15 years until selling it in 2021 for rupees 2 crores. Assume that she spent rupees 5 lakhs on the closing cost, the real estate agent charges and the real legal fees in connection with the sale. So, following is the formula that can be used to determine her long-term capital gain. The sale price multiplied by long-term capital gain is equal to 2 crore rupees minus 50 lakh rupees, that is the cost basis, minus 5 lakh rupees, that is the adjustments. So, 1.45 crore rupees worth of long-term capital gain. So, Sunita is eligible for a long-term capital gains a tax treatment because she owns the property for more than 2 years. For the gains over rupees 50 lakhs, the long-term capital gain tax in India is presently 20%. So, her total tax obligation on the gain would therefore be equal to 20% of rupees 95 lakhs or rupees 19 lakhs. So, let's say about one more instance. At a price of rupees 500 per share in 2015, Rahul received 500 shares of Tata Motors from his grandpa, giving him a cost base of rupees 2.5 lakhs. At a price of rupees 1,500 a share in 2021, he sold the shares for a total amount of 7.5 lakhs. Assume he spent rupees 1,000 on brokerage charge for his sale. So, following is the formula we can use to determine his long-term capital gains. The long-term capital gain is calculated as follows. The sale price is equal to rupees 7.5 lakhs. Cost basis is 2.5 lakhs. Adjustments. So, the long-term capital gains is 5 lakh of rupees. So, Rahul received the shares as an inheritance. Therefore, his cost basis or step up in the basis is equal to the fair market price of the shares at the time of his grandfather's passing. Then we have a concept of capital losses and a carryover. For a minimum of 8 years, the capital losses in India may be carried forward to offset the capital gains. This means that if a person makes a loss on the sale of an asset, they can utilize the loss to lower their tax obligation in the years with the capital gains in the future. And it is very significant to notice that the regulations governing the short-term and the long-term capital gains and the losses differ. Long-term capital gains are the gains realized on the sale of an asset held for more than a year, as opposed to short-term capital gains, which refer to the gains realized on the sale of an asset held less than a year. So, a person can carry on a short-term capital loss forwarded for a maximum of 4 years to offset the short-term capital profits in the subsequent years. And similar to this, a person can also carry on a long-term capital loss forward for a maximum of 8 years to offset the long-term capital gains in the subsequent years. It is very important to keep this in mind that different sorts of assets like stocks, mutual funds, real estate are subject to varying laws about how capital gains and losses should be handled. So, for instance, up to a certain amount, long-term capital gains on the listed stock shares and equities-oriented mutual funds are currently tax-free, although the other asset classes may be subject to the various tax rates. So, basically we will talk about exemption in India. The tax exemption was included in Finance Act in 2018 and has provided stock market and the mutual fund investors with the sizable tax benefits. And it's very crucial to remember that exemption only covers the listed equity shares and the mutual fund with the equity focus. Other assets like real estate, gold, debt, mutual fund and the non-equity mutual fund have a different tax treatment for the long-term capital gains in India. And after deducting the indexation benefit, which raises the cost of acquisition to the cost of inflation, the long-term capital gains on the real estate are taxed at a rate of 20%, and the gold long-term capital gains are subject to 20% tax rate after indexation benefits are taken into account. Thank you so much.